This week, we're talking about the business cycle, also known as the economic cycle. Much like a wave, the economic cycle ebbs and flows between periods of growth and contraction. Economists mark points and ranges within the cycle to help understand where we've been and provide some hints about where we're going. Peaks and troughs indicate the range, and expansion and contraction phases constitute the overall movement. The business cycle looks at broad economic performance over time. To be clear, it is not whether a specific company has achieved its quarterly earnings estimates or saw its P&L move into the black during the holiday season. Just like the wave rises and falls within the tide, economic indicators such as unemployment and inflation also rise and fall in response to economic changes. For example, during a recessionary phase, the economy experiences a period of contraction, which often includes decreased employment, lower wages in aggregate, and declining consumer spending. Conversely, during an expansionary phase, indicators point positively. This cyclical behavior can show up in the news as stock market boom and bust prognostications. However, those fleeting moments are rare. Historically, we spend most of the time in the growth phase of the business cycle, which importantly has been longer lasting. Let's take a look at a couple of charts to get a sense of relative duration and intensity. The National Bureau of Economic Research, or NBER, maintains a chronology of U.S. business cycles. Here we can see that the gray shaded areas denoting NBER dated recessions. On average, there is a recession about every 6.5 years, going back to the 1950s. The blue line shows the unemployment rate over time. Now here's a chart showing the S&P 500 stock index and those same recessionary periods. This chart also displays bull and bear stock market movements over time. As we can see, economic expansion and advancing stock markets have been the normal state. This is a good reminder for long-term investors, especially after a year like 2022. Now let's look at returns after various market declines. Here we can see how markets historically performed 1, 3, and 5 years after declines of 10, 20, and 30%. Focusing in on the 20% threshold, we find that on average, after this level of decline, markets historically tend to advance 40 to 70% total during the ensuing 3 and 5 year periods. Now, importantly, keep in mind the measurement of these past results started after the various percent declines listed. Investing can be a series of 2 steps forward and 1 step back. Ocean waves can be unpredictable from one to the next. Changing tides, winds, and seasons all impact waves. Likewise, the economy and financial markets are not predictable. The business cycle is impacted by a variety of forces, both micro and macro. These factors are difficult to predict. We believe investors are best served by appropriately planning for short-term uncertainty with an added focus on the long view, enjoying your day at the beach while keeping your eye on the horizon.